5.8% rise in the price of gold on the week. Silver up 7.2% on the week, closing the week back above 70 at 72. That dwarfed the gain in the stock market. The Dow was only up about 1.65%, S&P up about 2.4%, and the NASDAQ up about 3.2%. But all these indexes still down on the year, whereas gold is still having a good year. The trade deficits are as bad now as they were back then. The U.S. economy has been very weak over the past year. The stock market gains have been minimal. I think since Liberation Day, maybe the S&P is up, I don't know what it is, 15% or something like that. I forget exactly, but gold's up about 50%. This was one of the most obviously unconstitutional taxes. So how did they not know this from day one? But we have a problem in the financial markets. We're going to have a problem in housing. We have a problem in stocks. All of this is because interest rates have been too low for too long. Buffett talked about how much damage that does. If prices are going up 2% every year, compounded, robbing people of their purchasing power. I mentioned that I thought the price of gold had likely bottomed. We got down to around 4,100 on Monday morning of that week before we reversed. And then we rose up, I think yesterday, we got as high as almost 4,800. So that's about a 17% rise. Gold ended up closing on the week at 46.76 because we did pull back yesterday in response to the president's disappointing speech, which I will get into next. But we still had a 5.8% rise in the price of gold on the week. So anybody who followed my advice last weekend and went to Schiff Gold and bought some gold and silver had a pretty good week. Silver up 7.2% on the week, closing the week back above 70 at $72.90. But an even better performance out of the gold and silver mining stocks. This is despite yesterday's drop and the fact that the week was only 3 trading days long, other than yesterday's drop. But so in the 4 days of the week, the GDX was up 14.5%. And the GDXJ up 14.8%. That's after yesterday's decline. So the first 3 days of the week saw huge gains, mostly in Tuesday and Wednesday. Most of the gain were those 2 days back to back.
What if I told you gold just crushed the stock market? And it's not even close. In just 1 week, gold surged nearly 6%, silver jumped over 7%, and mining stocks exploded double digits, while stocks barely moved. But according to Peter Schiff, this isn't just a rally. It's a warning that something much bigger is breaking beneath the surface of the global financial system.
That dwarfed the gain in the stock market. The Dow was only up about 1.65% on the week, S&P up about 2.4%, and the NASDAQ up about 3.2%. But all these indexes still down on the year, whereas gold is still having a good year, despite having its worst March since 1980. Within that, it's still having a great year. But I think gold potentially could have the best April. Not 1980. Gold had its worst month since 2008. In March. But I think gold could have its best month since 1980. That's when gold had some huge gains. And of course, that was the year that gold peaked out at 850. But we had some huge monthly gains. But I think the stage has been set for a huge monthly gain this April, given the magnitude of the drop that should not have taken place in the month of March. By the way, Russell 2000 also had a pop on the week, about 2%. But again, all these gains are dwarfed by the gain in gold and silver. Now, yields on U.S. Treasuries did fall slightly on the week, but not much. The yield on a 10-year Treasury closed at about 4.31 something, and on a 30-year, 4.89. So, the highest the yields really got was about 4.4 on the 10-year and 4.99. I don't think I ever saw us touch 5%. So we're not far from the absolute highs on yields. Dollar index also had a positive week, but just barely. I think it eked out about a 25 basis point gain to end the week just north of 100. The trade deficits are as bad now as they were back then. The U.S. economy has been very weak over the past year. The stock market gains have been minimal. I think since Liberation Day, maybe the S&P is up, I don't know what it is, 15% or something like that. I forget exactly. But gold's up about 50%. 50%. Not a lot of people might have anticipated that the market that would react the best to the tariffs would be gold. Because everybody said that the tariffs were going to strengthen the dollar. That didn't happen. The dollar is a little lower than it was on Liberation Day. But gold is substantially higher. And of course, if you recall the podcast that I recorded, my very first one after Liberation Day, what did I say? I said the tariffs were unconstitutional. I said it very clearly. I explained exactly why they were unconstitutional. I said the president has no authority. They're not reciprocal. They're reciprocal in name only. We weren't reciprocating against anything. I said these were across the board revenue-raising tariffs, and the president had no constitutional authority to tax the American public, that Congress needed to do it, that it needed to originate in the House before the Senate had a chance to vote on it, and then only after it passed both houses of Congress could the president sign that kind of a tax hike. Well, recently the Supreme Court agreed with me in I think it was a 6-3 decision, and declared those tariffs unconstitutional. Thing is, it took the Supreme Court a year. I knew it was unconstitutional day one. The problem is it took so long. There should be a quicker process to get an unconstitutional law struck down, because we had a whole year where people paid an illegal tax. And now it's going to take many, many years for the people who paid that illegal tax to get their money back. And of course, a lot of businesses may have raised their prices in response to having to pay the illegal tax. The customers who paid those higher prices, they're not going to get their money back. So if there's a refund at all, it's just going to be to the businesses. They're not going to refund it to the consumer. So this is a huge problem. But it should have been obvious. It should have been obvious to Donald Trump. It should have been obvious to his advisors. I mean, how could you not know? This was one of the most obviously unconstitutional taxes. So how did they not know this from day one? Why enact a tax that is clearly unconstitutional when you're going to create such a huge problem with having to refund it? So I don't know, like, if the president didn't get any good advice from any of his advisors, or if he was told it was unconstitutional, but just do it anyway. Who cares? Who cares about the Constitution? Who cares about your oath of office? Just enact it anyway, and we'll roll the dice. I mean, maybe the Supreme Court will have a bad decision. I don't know. But I was very adamant that it was an easy call. It really should have been 6-0. I don't know why any of the justices went the other. Maybe it was 7-2. No, was it 7-2 or 6? I forget now what it was. But there was a dissent, and there should have been no dissent because it's so obvious. I mean, any justice. I mean, I know Clarence Thomas dissented. I lost a lot of respect for him. I thought he was one of the better justices on the Supreme Court. I don't know how he could have got this one wrong. Anyway, another big development, though, on the week, and this story has been building, and I haven't really touched on it in prior podcasts, but we've had several funds that have shut down to redemptions, meaning that investors who have asked for their money back have been told that you can't get it. And as more and more funds shut down their redemptions, that creates a moral hazard or a self-fulfilling prophecy where more people want to redeem. Because now, if I have money invested in a fund and the redemptions haven't been stopped, but I see other funds are halting redemptions, I may think, you know what, I better redeem my money now while I can before it gets closed. So this is going to be a big problem for the investment management industry, when now you have a lot of people who are worried that if they don't get their money out now, they're never going to get it out. And of course, if a lot of these funds own illiquid assets, or maybe there's liquidity there, but if they go to sell right away, they're going to drive the price down. And if the markets realize that certain funds, which have large positions in certain assets, are getting big redemptions, they may front run the trade. They may start selling those assets themselves. The bids might back away, and you have a real problem. But also, what this probably reveals is that a lot of prices may not be the real prices, because if companies are getting redemptions that would require them to sell assets, and now they're closing the door so that people can't redeem, assets that should be being sold are not being sold because they're halting the ability of people to sell. Well, clearly that could be distorting prices. Maybe these prices would be a lot lower. Of course, they would be a lot lower if the owners were allowed to sell, but they've locked the doors. And so that means the information that we have, the pricing mechanism in the markets, is faulty because we're not allowing the redemption. So this is another sign, too, of a major financial problem that is brewing that could hit, any day.
Let's start with what just happened. Gold surged 5.8% in a single week, while silver climbed 7.2%, closing back above $70. Meanwhile, the Dow, S&P 500, and Nasdaq barely gained between 1% to 3% and are still down for the year. Even more shocking, gold has risen roughly 50% since Liberation Day, completely outperforming traditional markets. And it didn't just creep up, it exploded. After dropping to around $4,100 earlier in the week, gold skyrocketed to nearly $4,800, a 17% move in days. That's not normal market behavior. That's capital rushing somewhere for safety. And it's not just gold. Mining stocks like GDX and GDXJ surged over 14% in just a few trading days, signaling aggressive institutional money flowing into hard assets. So what's driving this? According to Schiff, this is happening because the entire financial system has been artificially propped up for years. Interest rates were kept too low for too long. Markets became dependent on cheap money, stimulus, and what investors call the Fed put, the belief that central banks will always step in to save the market. But now that safety net is fading. At the same time, the economy is weakening. Trade deficits remain massive. Stock market gains have been minimal, and cracks are starting to appear in places most people aren't even looking. For example, some investment funds are now halting withdrawals. That means investors who want their money can't get it. And that creates a dangerous chain reaction. Because once people see others getting locked out, they rush to withdraw too, triggering a potential liquidity crisis. Even worse, it may be hiding the true value of assets. If investors can't sell, prices aren't real anymore. They're artificially held up. And that's where things get serious. Because at the same time, government policy is adding fuel to the fire. Schiff points out that tariffs, which many believed would strengthen the dollar, actually did the opposite. Gold soared, the dollar weakened, and later, those tariffs were ruled unconstitutional after a long delay. But by then, the damage was done. Businesses had already passed those costs to consumers, meaning everyday people paid higher prices and may never get that money back. Which brings us to inflation. Even legendary investor Warren Buffett has questioned why central banks target 2% inflation at all. Because over time, that small 2% compounds and quietly destroys purchasing power. Schiff takes it further. He argues that falling prices, deflation, would actually benefit everyone. Lower costs mean higher living standards. But instead, policy continues to push inflation, masking the true benefits people should be receiving. And here's the final signal. Buffett himself is sitting on record levels of cash, avoiding stocks, because valuations are too high and risks are rising. So when gold is surging, when funds are freezing withdrawals, when policies are failing, and when the smartest investors are pulling back, it raises one big question. What do they see coming that most people don't?
But we have a problem in the financial markets. We're going to have a problem in housing. We have a problem in stocks. All of this is because interest rates have been too low for too long, and they've been propped up based on the expectation that more rate cuts are coming, that we have a Fed put, that we have a Trump put. But now the markets think the war may have preempted that, and that the put is no longer there, and what's been holding up the market doesn't exist. In fact, I was listening to an interview of Warren Buffett, and I think it was on CNBC. He was interviewed. And one of the most interesting comments that Buffett made was that he said he doesn't know why, and he doesn't agree with the Fed's 2% inflation target. That he believes and he wishes that the target was 0, which is true. Why should the Fed target inflation? If the Fed's goal is price stability, then why target a 2% increase every year? Buffett talked about how much damage that does. If prices are going up 2% every year, compounded, it takes its toll. It is robbing people of their purchasing power. But I'll go a step further. Why target stable prices? What if prices were going to fall? What if prices should go down 2% a year? Why not let them? Why do you have to stop a good thing from happening? It is not a bad thing if the cost of living goes down. Everybody would agree. I mean, you could just do a random poll of people and ask them, next year when you buy gas, would you like it to be cheaper or more expensive? When you go to the grocery store next year, do you want to pay lower prices for food or higher prices? When you get your utility bill, would you like it to go up or down? You know, when you have to renew your kids' college, do you want to pay more next year or do you want to pay less? Do you think there'd be any consumer, any American who would choose higher prices over lower prices? Nobody would choose that. But even when it comes to businesses, if you ask the businessman, would you like your costs to go down a year from now so that you can lower your prices to consumers? Or do you want your costs to go up so that you have to charge your customers more money? Every businessman is going to say, I want my costs to go down. I want to be able to lower my prices, because every businessman knows if they can lower prices, they'll sell more stuff and they'll make more money on higher volume. So everybody is better off with lower prices. The producer is better off. The consumer is better off. So why target price stability if prices would otherwise go down? So there is no reason to have any kind of target. Just let the market determine prices and don't try to steal the benefits of falling prices by creating inflation and using the fact that the free market lowered prices or would have lowered prices to deceive the public and steal that gain. Because people have no way of knowing how much lower prices would have been if the government didn't rob them of that benefit by creating inflation. So I agree with Buffett that a 0% target is better than 2%, but I disagree that we need a target of 0. I disagree that stable prices are better than falling prices. Falling prices lead to higher living standards. And so I'd rather have that than stable living standards. And in fact, if you look at the amount of cash on the balance sheet of Berkshire Hathaway, it's an all-time record high. Now, I criticized Buffett in the past for not keeping his dry powder in gold. And I think maybe he would have preferred to keep it in gold, but I think he was very cognizant of the message that might have sent to the world, because the world really looks at the Berkshire portfolio. And had Buffett maintained a large gold position, that would have been a major vote of no confidence in the U.S. and the U.S. economy. And I don't think Buffett wanted to signal that loss of confidence, even if in his heart of hearts he believed it. And I think he probably understood that being in gold would have been better than being in U.S. Treasuries, but he took Treasuries anyway because I think he was afraid of what might happen if he loaded up on gold. But what he didn't want to do was load up on stocks, because he recognizes how overpriced the U.S. stock market is and how there are no real good values to be had given the valuations and given the economic problems that he clearly understands are in front of us.
This isn't just about gold or silver. It's about understanding where the system is fragile before it breaks. Because by the time everyone sees the crisis, it's already too late. If you want to stay ahead of what's coming next in gold, silver, and the global economy, make sure you subscribe, and I'll break it down for you step by step.